And so on the question, we don't have a question and answer section, but we do have a chat. So if you want to put something in the chat, and I don't know if Tiffany, you can kind of monitor that. If someone has a question, I don't know if you can monitor if people are raising their hands, they can ask a question as we go along. You know, you can also say, I know when I first read this, I was like shocked. I said, boy, I'm going to have to really do some tax planning because of this. So let's start with our poll question. Do you think your federal income taxes will increase under a Biden tax plan? Yes, no, not sure. Okay, it looks like we might have most of our numbers in right now. I don't know if you guys, I think you guys can see the polling results too, right?
Yes.
Right now it's 69% say yes, 7% say no, and 24% say not sure. Okay, let's go to the next slide. Or do I need to stop that?
You can go.
Okay, the poll's still up though. Okay, on mine. Okay, so our agenda today is to go over the Biden tax plan. You know, with the Georgia election, a Biden plan is even more probable. I think it's still without the Georgia, there was a good chance that a lot of this would go through. And I don't know how many people have read this, but this was actually put out by the Joe Biden prior to the election. So you would know what his tax strategy was. And a lot of it he did mention also when he was campaigning. Then we're going to go through how to give to your local charities and it costs you nothing. This will be to the state of Arizona. And then kind of as a bonus, since it just passed, I included some information on the $900 billion in emergency corona relief bill. And if we have more questions on that, I know we have a resident expert in Cody, right, that can help us with that. Okay, next slide.
Okay, really quick though, from Susan McCall, clarifying question. Do we actually know the Biden's tax plan yet?
No, we don't know the plan yet, but this is what his proposal was. And a lot of times when they give a proposal, they could actually give an effective date as of January 1st because they said, well, everyone knew about it. This is what, so we don't know what the effective date was. I'm kind of hoping that he really concentrates on maybe more the emergency relief, the 2,000 to individuals, maybe doing infrastructure before he goes to taxes, but he could make it retroactive back to the first of the year. So, but there's nothing in concrete yet. There's no changes yet. Okay, so a summary of Biden's tax plan prior to the election. His plan would raise tax revenue 3.3 trillion over the next 10 years. Biden's plan would raise taxes, and I think he's mentioned this, that most people that were making higher incomes would be paying more taxes, but they kind of picked this $400,000 number. So if you make over $400,000, your income tax rate's going to go up, your capital gains are going to go up, and your payroll taxes are going to go up. So it's going to hit you quite a bit there. And also, he plans on raising corporate taxes and then also imposing a minimum corporate tax rate, similar to what we used to have with the alternative minimum tax rate. And according to the Tax Foundation, the Biden plan would reduce GDP by 1.62% over the long term. The Tax Cut and Jobs Act benefited most Americans, as I mentioned before. Biden's plan would appeal many of those provisions. Here's some of the key ones. I'm not including everything in the presentation, but mostly ones that affect real estate or individuals. a lot of people used to pay alternative minimum tax. That was phased out until you made over $1 million. That will be put back in. Estate taxes were increased to 11.2 million and 22 million point 4 if you were married. So he plans on appealing that. Go to the next slide. These are two big items. He plans on the deduction for the 20% of qualified business income, the 199A. The main reason that was put into effect is we lowered the corporate rate from 35% to 21%. And so if you weren't a corporation, but you were an LLC, you didn't get a deduction in your taxes, even though corporations did. And so then what you could do is change to a corporation. But instead of doing that, they said, well, if you have a qualified business income, you can do a deduct of 20% of your income. And that way it kind of evens out you received a tax benefit also. Another big item in real estate and all businesses is you got a bonus depreciation. And bonus depreciation used to just be for new, but this included new and used property. And just to give an example, let's say I'm doing a tenant improvement and it costs $200,000 to do a tenant improvement. Well, with the bonus depreciation, I can write off that $200,000 that year and reduce the income for that. Under the old law, that $200,000 would be depreciated, and your depreciation per year would be about $5,000. So a pretty big significant item with that. Okay, next slide. We'll go into a little bit more detail with the 199A deduction. Many sole practitioners, independent contractors, real estate agents, pass-through entities, whether you're a partnership, LLC, S corporation, you would receive this 20% deduction for business income earned by that business. And so let's give an example. You make $100,000, this is net business income, but you would get a $20,000 deduction, which is the 199A. Therefore, you would only pay taxes on $80,000. And as I mentioned before, that kind of equals the playing field. We reduced the corporate, but what did we do for individuals, partnerships, other businesses? Next slide. This is plans on eliminating the 1031 exchange. And I don't know what you guys think about this. This has actually been in the tax code since 1913. So this is a pretty drastic change. The elimination of the 1031 would increase cap rates substantially, and it would basically devalue real estate. In Arizona, over 60% of Arizona investment sales are to California 1031s. And if you look at most sales, they probably involve, that's just California, but probably 75, 80% of most investment sales involve a 1031 exchange. Okay, this is just a graph of what was passed under the last Tax Act. And if President Trump was reelected, his plan was to make this permanent. Currently, it will be phased out, but what Biden's tax plan does is will appeal most of those prior to their expiration. So if we look at the individual, because we had individual rate cuts across the board, those were going to expire in 2025. The 21% corporate rate was going to expire 2027, pass-through deduction 2025, 100% expensing was going to be 2022. And then there's a few other items on there. Next slide. Okay, here's where we're going to be. If you make over $400,000 in wages, plan on paying more on Social Security. Right now, with Social Security, you pay Social Security tax up to $137,700. Okay, Well, he's going to raise that to 400,000. So you're going to be paying 12.4% more from the 137 to the 400. And then he also plans on raising, originally they were going to raise, right now the top rate is 37%. He was going to raise it back to the 39.6%. Now he's talking about revising that to 45%. So when you look at that, at the top end, you're going to be paying 57.4% in taxes. And then if you add our new Arizona tax, which is 8%, you're going to be at 65.4%. So that will be substantial increase in taxes for people making over $400,000. And then what he also wants to do for individuals that make over $1 million, he wants to start taxing those at not your capital gains rate, but your ordinary income tax rate, which he's proposing at 45%. So right now the capital gains tax level is 20%. Well, now you're going to pay 45%. And so you'd pay that on dividends, you'd pay that on, all types of items. And this is similar, if you're not aware of this, California has a similar law to this. And I was kind of waiting when other states were going to adopt it. Other states are looking at it. In California, everything's taxed at ordinary income. There's no capital gains tax. There's, nothing of that basis. So you just pay whatever your ordinary income tax rate is. Okay, next page. And then plus, if you make over 400,000, your itemized deductions are going to be decreased or limited, and you'll receive no 199A deduction. And then he wants to roll back the estate taxes back to the 2009 level. We'll go to we already went to the next page. Okay, go back one page. Okay, thank you. Okay, so we kind of talked about individuals. Let's talk about corporations. Right now, corporations pay 21%, and we're paying 35%. He's proposing that goes up to 28%. But the big kicker is on companies that make over 100 million. He's suggesting we put an alternative minimum tax. So they're going to pay the greater of the regular corporation tax or 15% minimum. So, there's a lot of large companies that make over $1 million that pay no taxes. Well, they're going to end up paying at least 15% at a minimum tax rate. Okay. He also wants to change and give more tax credits for energy efficient items. And he wants to eliminate any of the subsidies we now give to fossil fuels. Next one. Okay, I noticed we had some people from Larson Baker on the call. Opportunity zones. Opportunity zones have been good for real estate, but he believes they're not living up to their economic and community goals. So what he would do was he would want to change those a little bit. He's not saying eliminate opportunity zones, but what he's saying is to get the tax rate, they need to provide more detailed information about the opportunity zone, including projected impacts on poverty rates, housing affordability, and job creations. So then also to get the tax breaks, you got to show that there's an economic, social, and environmental advantage for the community, not just for, that community has to benefit from it. So if you build, luxury apartments in an opportunity zone, that might not be benefiting the local people in that area. And the opportunity zones were picked by the governor. The governor of each state decided what the opportunity zones were for that state. So some of them might not go into this tax break of providing economic, social, or environmental advantages. And then what he'd like to do, he would like the opportunity zones to team up with not-for-profits and community-oriented organizations to show that there is a community benefit for each of those investments. And so then you're going to have to do a little bit more reporting to show this information. Plus, if your project doesn't meet these, you're going to have to maybe revise those projects to meet these various goals. Next slide. Okay, what does this mean? I think what it means, I mean, you know, when the Jobs Tax Act came out, you really didn't have to plan much. It was mostly, most of the tax things changed. There was added benefits that benefited most Americans. On some of these things, there's clearly items that aren't going to benefit you. So you will have to maybe decide, I'm going to have to probably do more tax planning and more thinking about what I'm going to be doing. You know, state taxes, he wants to go from, and this is for an individual, it would double for a married couple filing jointly, 11,180,000 to 3.5 million. Another thing what he wants to do, if you guys have ever talked about, is he wants to limit up the step up in basis. So let's say I had a bunch of Amazon stock I bought for $1 and now it's worth $100. Well, at the time of my death, it's valued at $100 to my, whoever I give those to. Well, now they're saying, no, it's going to be valued at $1. And so, because there's no step up basis with those items. And if the people sell it, they're going to have to pay the capital gain of the difference between the $1 and the $100. So the people that inherited that would pay $99 per share in that. And then, so the new taxes, you might be in a position that your capital gains and qualified dividends are at your ordinary income rate. Well, in prior things, what you would kind of do is like you would speed up your expenses and defer your income to the next year. You might be doing the reverse now and say, well, if this tax law is going into effect, maybe I need to accelerate my capital gains to get the 20% deduction versus paying 45%, or I want to increase income. So you kind of do the opposite approach that people have probably done before. And the winner of this will probably be CPAs and attorneys. You know, state attorneys will start doing new estates. Jim's going to benefit from this because he'll probably end up doing a bunch of appraisals, you know, for estates. So, but it's something that you probably have to think about a little bit more. Okay, let's go to our next polling question. Okay, now that you know a little bit about the Biden tax plan, how much more do you think you would be paying in taxes? We still got a few more coming in. Okay, I think we can stop it there. Okay, so 35% say 10%, 38 say 20%. I mean, just alone, if you were taking the 199A deduction, you're going to be paying 20% more, probably in that case. 19% say 25, 8% say 35%. I know a lot of people, when the first year came out, they were paying quarterly taxes, and a lot of people said, well, I didn't need to make my last quarter payment, which would be 25%, because they already paid their allotment in the first 3 quarters. Okay, next slide. I think, do I need to get rid of that, or do you need to? Okay, I got rid of that. Okay, now we're going to talk about state tax credits. And maybe you guys put in the chat if you do use state tax credits. So on these state tax credits that I'm going to mention here, you get a dollar for dollar tax credit. Okay, and I've got a list of all these various local organizations that you can give to that's on that slide there. And so why do you want to give? Well, the first reason makes you feel good that you're going to give to them. Okay. The second reason, I don't know if you know this, but because of the way our sales county tax, sales tax, and income tax are allocated, they're allocated to cities and towns. And I'm sure you've heard Pima County is one of the largest unincorporated counties in the U.S. Maricopa is 95% incorporated. And so when they divvy up your state income tax dollars that they collect at the state level and your sales tax dollars that you collect at the state level, they reallocate it to the cities and towns. So approximately $200 million of Pima County sales tax and income tax is allocated mostly to Maricopa County. So this is one way we can make sure some of our money stays locally, is by giving to these tax credits. And the third reason to do it, it costs you nothing to do it. And that you're giving to, so then you really have a choice. Do I give to my state tax dollars to the state, or do I give to a charity of my choice? And I would pick to keep it locally. So let's just go through a few of those. We'll go to the next page. Now, the ones that we have here, these are dollar for dollar tax credits, so it doesn't cost you anything. The ones we have presented here equal $4,565. And most of these you can still claim by donating. You can still claim for 2020 by donating prior to filing your tax return, which would be, if you take it to the April 15th, 2021. So let's just go through a few of these. Contributions to qualified charitable organizations. This used to be known as the Working Poor Credit. The maximum is $800. Some examples of these charities are Big Sisters, Big Brothers, Boys and Girls Clubs, Community Food Bank of Southern Arizona, El Rio, Healthcare, Girl Scouts Goodwill, Habitat for Humanity, Easter Seals. And then we also have $1,000 for qualified foster care. And these are all for married. So if it's single, you just divide them by half. Example there, Easter Seals. I collect for the foster care for Easter Seal when I do the El Tour. And so the people that are donating to that for the ride that I'm doing, they get, if they have $200 in taxes, they'll get a credit back. It really costs them nothing to do that. And you're helping a great organization. One that's been around for a long time is your $400 tax credit to public schools. And this is for extracurricular activity, field trips, and stuff like that. Next page. Then we have our school tuition credits for private schools. This includes parochial schools. And with that, some people think, well, if I give one of it or a part, you can give this to many schools. You just can't go over the 2365. So part one is 1,186. Part two is 1,179. But I could give that to 4 schools if I chose to. Next slide. Okay, so this is an example if I owe the state, or my tax liability is $5,000, and this doesn't really matter if you have a refund coming or you're paying them. It's just saying you owe taxes to the state of $5,000. By giving to these various organizations, you can reduce your state tax. You can reduce the taxes that you pay to $435, and then you would be helping all the organizations of your choice. Okay, next poll question. Would you utilize the state tax credit to give to your local charities? Yes or no? You don't have a choice of saying not sure. Okay, so it's 84% and 16%. So 84% would say yes. And then some people ask, well, what if I don't know what I owe? I mean, and that's one reason they extended it to the April 15th is you go and have your taxes done and you owe a certain amount, well, then you could decide to give to some of these organizations. And some people that give during the year, they say, well, what if I overpaid it? Most of these you can carry forward up to 5 years. So you really don't lose it. It just applies to another year. Okay. Since this passed December 27th, 2020, I just thought I'd mention it. There's a little bit difference. I've kind of passed it on to all my tenants just so they're aware of it. As probably everyone in the room knows, we passed the 900 billion emergency corona relief for family workers, small businesses for the house crisis. They did add an additional PPP of $284 billion, but they did some twists with the PPP this time. They said the PPP loans will be available to businesses with 500 or fewer. That was the same as the previous law, but they're saying that did not previously receive the PPP loans for payroll, rent, utilities, healthcare costs, and more. So, because a lot of the small businesses that didn't get it last time, they said, well, all the big companies got it. Well, what they're trying to do this time is say, okay, if you didn't get it last time, you're going to move up to the first in line. You're going to be the first ones to get it. Is that right, Cody? He's shaking his head, yes. Okay. And then in addition to that, with the new PPP for the first time borrows, the legislature will allow you, if you've already received your second draw and you've already used your first draw, you can apply again. But then they added some caveats. You can't have more than 300 employees. So then what that did was, before I qualified under 500, but now I have 325, I can't apply. And then you have to demonstrate that you actually had a reduction of revenue of at least 25% in the last quarter, or quarter by basis of 25%. Because some people did receive the PPP last year, and they were maybe essential businesses, and they really didn't have a big drop in their revenue. So they're adding a little bit of a revenue one on that one. And so do we have any questions? It won't be in the questions and answers. It will be in the chat. So Tiffany, I don't know if we have any questions.
Not yet.
Okay.
If you guys want, though, you guys can unmute yourselves and ask that way. A little bit more engagement with everyone.
Okay, that's a good idea.
Who's on the phone, yeah. So just treat this like a normal chapter meeting and talk among yourselves.
Cody, do you want to add anything on the PPP? Because I know you've gone to a lot of trainings on this.
Yeah, so we just got an email about it a little bit ago. It is currently open to first rounders right now that are also for CDFIs. I believe maybe BDFC would be involved in that right now, that they can do them. They have not really announced when banks will be able to actually start submitting. We're hoping that we'll start submitting later this week, that they'll start accepting our applications. But most banks are starting to have opened their systems up to allow applications so they can start getting things ready and do due diligence. One thing I thought was interesting is they put out saying that they are not going to basically really auto approve. They are going to take their time and really go through them, which I think is a different approach. So I do think it's going to take a little longer to get your funds this time, just to get approved, just because they're going, banks are going to have to do their due diligence on it. And then same thing with the SBA. There is some extra pieces where the 501c6s will be eligible now. So those would be your political organizations. They will be eligible. I mean, again, what you said is it's catered more towards these smaller businesses, is the piece I was getting from it.
And so it would probably be a little bit more work on the banks up front than before. Before you just had to look at what your payroll is, and then you get your 2.5%. And
Yep. Yeah. So we're going to definitely have to, I think there's going to be a lot more questions asked, more information has to be provided by the clients so we can do our review and make sure it meets those guidelines. I think a lot of banks have been really pushing forward recently to get their technology up to date so they can handle this. I know my bank has definitely done that. We are very big in the technology aspect of it all. And also moving forward to minimize the client's impact and to to speed up the process for them. But yeah, I think there's going to be a lot of, as I do think it's going to take a little longer to get funds just because of all the due diligence that's going to have to take place for it. So, and the good thing is it does show that it is going to be forgivable as well. So, that is the nice part.
okay, Tiffany, do we have any more questions? I don't see, well, some people, their faces aren't here, so I can't see if they raised their hand, unless they raised it through the participants thing.
No, nobody through chat. But
Okay.
again, you guys can just unmute yourselves and start talking and asking questions.
Hey, Gary, James here. I got a question for you, Gary. This kind of directed to the landlords. They're negotiating tenant improvement allowances for the tenants. How's that going to affect us in our negotiations going forward in 2021?
Well, I know. Okay. Oh, I'm echoing for some reason. Oh, it's because we muted. Okay, is everyone muted now? Can you hear me? Okay. I think it's because everyone was on. It will affect it quite a bit. I know, I mean, I always, when I look at someone that's doing a lease and they're asking for tenant improvements, of course you want to credit tenant in there. You want to make sure that you're just not going to make improvements and then a year later they move out and, these, $200,000 worth of improvements that, won't meet the next tenant. So by getting this deduction though, it gave you, maybe I was more willing to give, maybe instead of 100,000, maybe I'm more willing to give 150,000. I'm still going to look and see if it's a quality tenant and hopefully that, they'll be there. But the fact that, you could write off the 150 right at first. And also before, in a lot of cases, we used to do, for new shelf space, a $50 tenant improvement allowance. With now construction, it's costing $80 to $100. And so we've actually maybe for, certain tenants have increased the allowance, the tenant improvement allowance to maybe 60, 70, or maybe even to a build to suit. So, and that's because you could write it off. So now not with being able to write it off, you're going to think a little bit more on how much of an allowance you're going to give. So I think it's going to affect the tenant improvement allowance quite a bit.
But do you think some of these landlords that are sitting on gray shell buildings might go in there and turn them into white shell buildings for the tax law changes?
That, I mean, depending, they could go retroactive since he put the plan out prior to being elected. They can say you knew what the plan was. Okay, so it kind of depends on what they put as, and they usually like to put it, they don't like to put it mid-year. They like to do it January 1st. So if they do it January 1st, that's not going to help you too much. But, you could take the chance and say, you know what? I don't know if they're going to pass it this year. They got a bunch of other things happening. But even if you look on the phase out, this one was phased out in 2022. Well, if I had those shells and they still haven't passed that the 100%, you still get the 100% bonus depreciation, I would definitely be taking my shell space to white space.
Anyone else? Gary, thank you very much for putting on this presentation. It was very informative. And we'll be doing something similar next month. It will be done by Jessica Moran, and it will be the CRE overview of Southern Arizona 2020 as recorded and forecast by CoStar going into the future. Thank you all for attending. I appreciate it very much. Thank you, Gary, again for your presentation. Thank you. Bye now.
Good job.
Good
Happy
job.
New Year.
Happy New Year, everybody.
Thank you all. It's been a slice.